It's a very important topic. Previously, we just seen about money, lazy Canva, each and everything. But in financial sector, if your money should work for you, you need to invest on assets. So we can dive into the asset class to invest in. Let's go deeper. There are a lot of assets are there. There are a lot of assets are there. Even I said in money, about when we are talking about money, even the liability can change to asset if you do the proper math. So everything is possible, everything can change to asset if you do the proper system and proper math. For example, if you have the iPhone, even you can make the iPhone as an asset. If you do a content creation by that, if you're earning money, then that's going to be an asset for you, because with that you're just going to give the clarity and the quality video. Because of that it get more reach. Because of that a lot of people have watched and they just give engagement, or they just bought your product or anything like that. So that's going to be asset for you. Same like that, we are going to see the asset classes. What are all the asset classes are there and how much risk is there, whether what are all things you can do. Let's see now. The first asset class, if you ask me, or like if you ask a lot of people, they will say fixed deposit. What is exactly a fixed deposit? Guys, fixed deposit is having something called locking period. For example, you need to lock your fund for 1 year or 2 year or 3 year. So if you give the promise you're going to lock it, you should lock it. If you're not locking, if you're taking it in between, they are not going to pay you money. Instead of that, they are going to deduct some money as a penalty or as a fine or as a fees. So locking is the major minus point in FD. So really here I just given in everything there is no locking. In every asset you can see, when you liquidate that asset you don't have anything like locked. But in fixed deposit you have something like locked. But because of locking it, your capital is safe and you're going to park your money somewhere for shorter time period. Okay, again I'm saying fixed deposit is not for longer time period. Why is fixed deposit is interlinked with lot and lot of things. Inflation, or the country is having deflation, or the country economy is collapsing, or the Fed interest rate increase or decrease. So it's like interlinked with everything. So there is no fixed that you're going to earn this. That's what the locking period. So till you lock, they will give promise. Till you're locking 1 year, I'm just going to give this much of percentage. But within this 1 year, if the interest rate is reduced, and they are not going to do anything. They are, because they just promised, because of the promise you locked it, so they're just going to give. But after after your capital got mature, you should lock it again on that time period. Whatever the interest rate on that time period, you will get it. So you got my point, right? So this is like safeguarding your capital for shorter time period. It's not for holding for 20 years or 15 years. None of the banks will give 10 or 20 years with the fixed income, with the fixed deposit. If you check the US fixed FD is like very very low. So that's what people would be shifting their money to equity, other stuffs. They will be like investing on these things. Next one is savings account. Savings account is like, you can, like for example, if you're the person, if you're focusing on emergency fund, like for daily liquidity is nothing but transferring, sending, buying, using. If you're going to be like have some emergency fund for your that 1 month of time period. For example, you got the salary today, you feel like you need $100 for next 1 month to buy the grocery and everything. You can have it on savings. So for that savings, you have annual income. You have 2 to 5% based on the countries, but the liquidity which you're going to make is very high, and same time you're not going to earn much. Okay. And next thing we can come, which is like government bonds. See, if you see the risk level, government bonds are very low risk, and the annual return would be like around 5 to 7%. And the liquidity, if you want to liquidate that, even there they will charge you if you are going to sell it. If you're going to sell the bonds, they are going to charge you. So the exact liquidity is medium. and one of the safest income you're going to get equivalent to FD. Okay, because government, you just bought the government bonds, so you're just given, loan to government. You just given your money to them, so they just promise that they are going to give this much of interest on this year or this much of time period. So it's going to be safe, but the interest is going to be equivalent to FD. Government bonds are less earning. It's not like high earning, it's like less earning compared to FD. It will be equivalent or sometimes little higher or sometimes little lower. So that's what it would be. And the next one is corporate bond. See, in corporate bond, your risk level would be low or medium. It's going to be neither based on what kind of bonds, what kind of corporate bond you're going to choose, which corporate is going to give, whether they are paying the customers back or not. With the track record, if you're going to be invest on corporate bonds, then you can expect of yielding 6 to 12% year on year. But it differ based on countries. Again, I'm saying it's differ based on countries. It's not like this country or that country. I just taken the normal average data. It's not the perfect exact data, normal average data with the worldwide. Okay, and here you're going to earn the regular income with a moderate risk. Again, I'm saying it's not a low risk, because if you go with the corporate bond, we don't know whether the corporate is going to collapse or they're going to bankrupt. You don't know nothing. So corporate bonds are moderate risk. Okay, and next thing we can come to equity, which is like high risk, and you can expect of return 10 to 15% per annum. And if you want to liquidate, you can liquidate it any time. It's not like you like, for example, if you want to sell today, you can sell it and tomorrow you can take it. But other things and all, it is having mature period, you need to wait for that. If you're canceling, you won't get the interest, and a lot of things are there. And if you're going to build a long-term wealth, equity is the best option. Equity is best option for long-term wealth. If you take the track record of 30 years, none of the equity has been grown downside. Only, if you invest in the small cap or something, you would be in a trap. But if you invest on the top 50 companies, somehow they performed good. Somehow you'd get the dividend, or somehow you'd get a stock split. Somehow your capital will grow in the long run. So equity is mainly focused on long run. Next one is mutual fund. So mutual fund, or you can take it like hedge fund, institutional funds, lot of things are there based on the countries. So here the risk is from low to high, because in mutual fund you have different categories. For example, you have depth mutual fund, you have based on equity base, you have based on quant base, a lot of things have came. You have 1,000+ products in mutual fund. So based on the product you're going to select, the risk will be vary from low to high. So if you ask me, if you want to liquidate risk, like, you can easily liquidate, because mutual funds are very easy to sell it and take your money back. So it's going to be diversification your portfolio with several assets. It's not like trusting one and focusing on that one. Okay. And the next one is ETF. So ETF is also same, like from low to high risk, because ETF is also like a depth ETF. Like, you will have a commodity ETF, you have the indices based ETFs. You like ETF is also have the same, like from low to high risk levels, and the earning also would be 6 to 15% per annum. And if you want to liquidate the ETF, it's very high, very easy to liquidate the ETF, and you can make it as a cash. But the thing is, you have the low amount of exposure to a big opportunity. If you directly invest on equity, your making money is very big. But if you're investing on ETF, you won't get the dividend, you won't get the share split. But some ETF provider, like some ETFs are like that. Some ETFs are there where you will be getting dividend, but most are not like that, because you're just going to buy, a bunch of equity, or bunch of package you're going to buy. So they would be they would be having some kind of a mathematical equation to allocate the asset based on what the ETFs you're going to buy it or choose it. Okay. And next one is a real estate. Real estate is medium risk, and you can expect of 8 to 12 percentage per annum, because rental income is there and your land appreciation is there. And for selling, if you want to liquidate that, it's very low. It will take a lot of time to liquidate. For example, if you're buying a land and if you're going to sell it, it's going to take a longer time. Sometimes even it can take a decade if the land is not in a proper condition, or if the land is not in a proper way. Then if you are going to sell it, it's going to take a decade to sell it. So for making liquidate your real estate, it's going to be very difficult. And remaining like commodity and gold and these things and all, having a medium risk. And with this, what you can do is, you can, like for example, if you, instead of holding your money as a cash, you can put it on these sectors, so that your cash will be grown based on the inflation. Okay, I will go with these top 3 topics later. Then we can go with the next one, the cryptocurrency, my favorite one, which is like having a very high risk and highly variables, like nothing but you can't even predict how much it can go. Some cryptos pumped nearly 10,000, 100k percentage. Some has been from there, it has been fallen to zero. So risk is very high. You can liquidate at any time because it's open 24/7, and it's totally a speculative market as of now. But in future things can change. So you need to be more and more careful. There is no guarantee that you can make this much or that much. You can go to zero, same time you can go to the millions of dollars. So it's apart from what you're going to do and what kind of strategy you're going to follow. And private equity is like it is having a very high risk, because they will accumulate. You're just going to give your money to the private equity fund, and they will buy a company, and they will do the modification, they will make it little profitable 1 or 2 years, and they will sell it to the other companies. Even private equity will focus on buying stocks which is not listed on the exchange. They will buy, they will like you can have the angel investors, you can have so these kind of investment models can come. So in private equity, risk is very high, because if you're investing on 10 companies, like if you invest on 10 startups or 10 small companies, in that 1 or 2 can perform good, remaining can go zero. So you need to be ready for that. Hedge funds are riskier, risk is very high, and your profitability is totally based on what kind of profit they're going to make, because they just belongs to the market. So that's where the institutional and H9I investors will come inside. But the problem is, risk is very high, and if you want to liquidate, it's very low, because you just given money to the traders, they are going to make money for you. So risk is very high. Instead of that, you can choose the top 5 or top 10. That would be very helpful for you. So here I just given very clearly of each and everything, but I just explained each and everything in a very easier form, so that you can understand. I think this video would be more and more helpful for you. Let's see you on the next video. Bye.